Hi, this is SG Financial 101. Today we're going to talk about endowment plan, endowment insurance. Mm. So previously we have been covering on CPF. So let's change the topic for today. So this article is taken from Value Champion, written by senior research analyst Anastasia. Okay, so endowment plans are created by insurance company. They are commonly marketed as saving plans towards consumers, mm, which many of you actually could have heard or could have heard it before, or some of you actually could own an endowment plan right now. So they are primarily used for saving purposes, also probably provide a little bit of life insurance coverage. Most plans are term plans, meaning they will mature within a set number of years, right? Yeah, because if let's say they are whole life plans, they are usually not marketed as endowment plan. They are usually marketed more as whole life plans. Endowment insurance plans are advertised as a form of forced saving, and this is correct because you're obliged to pay the premiums. This is especially so for the regular premium products. If you fail to make the payment in time, this might cause the policy to lapse, and the policy lapse can result in financial loss in that plan. Okay, however, unlike typical saving plans, you'll find banks and endowment policy are complex insurance products that have a lot of components that you need to fully understand before committing. Below, we break down and explain the features for endowment plans. Okay, let's look at the features. First feature is illustrated rates. So on the product illustration of an endowment policy, you will frequently see these under 3% and under 4.25%. What is the cash value or what is the surrender value of the plan? So these 3 and 4.25 are for illustration purposes. Of course, it can go higher than 4.25, it can go lower than 3. It's actually industry standard set by LIA, Life Insurance Association, as they don't represent the upper or lower limit of the investment performance. This is to get you a feel of how your investment value will, will perform under different kind of market conditions. Okay, then the other thing is about cash benefit. Some policy offer some form of what I call liquidity. Liquidity in the sense that you usually for endowment plans you cannot take out your money, but some of them actually have cash benefits. Um, this means that you can actually withdraw part of the cash benefit without penalty. But also most of the case, the insurance company will also reinvestment option. If you choose to park the cash benefit back with the company, you can earn interest on that as well. Next thing about that you see in the product illustration is this thing called total distribution cost. So what is total distribution cost? Total distribution cost is the cost of insurance paid to its distribution channel, i.e. Sales commission. But it's not just about sales commission. It's the total marketing cost actually. Typically, it's actually much more than the sales commission. Sales commission probably is only around 50% of the distribution cost, because these include actually marketing, whether it's traditional form of marketing or on the digital channels, because no advertising and marketing is free. Also include like printing of material, renting of office for you to conduct your marketing. And also actually you have to total and there's a lot of other costs as well. So this is commission, sales commission is just part of it as well. And say this cost is already included in your premium. Okay, 100% capital guarantee. Okay, some insurers advertise plans that have 100% capital guarantee. Okay, this depends on the illustration, right? So if the guaranteed capital at maturity, right? Guaranteed capital at maturity is higher than the total amount of premium paid, right? Then we can say that it's confident that this is a plan that offer 100% capital guarantee, right? So if you invest in a total amount, let's say $50,000, for example, and then when the policy matures, the guaranteed portion is already at least minimum $50,000, then we can confidently say that it's capital guarantee. Right? Otherwise, then it's not capital guarantee. Understanding your returns. Your endowment return will be made up of a number of components. It will change depending on the type of policy you have, and then when you decide to cash in. Below, we explain different terms. Okay, first is the guaranteed value. Guaranteed value is the guaranteed amount that you will get when your policy matures. It may be a predetermined amount that is specified when you bought a policy. In some cases, guaranteed sum might be less than the premium paid over the term policy. That's correct. Not all plans are capital guaranteed. This is because a portion of the premium goes back to paying for the life insurance portion of the policy. And that is correct as well, because different policies are designed for different purposes. For example, certain policy actually have actually a higher coverage. In that case, they might not be capital guarantee, 100% capital guarantee. There are also other policy actually pay you much more for bonuses. So in that case, right, these saving plans are considered slightly more riskier. So for more riskier plans, definitely they tend to be not capital guarantee as well, right? So it is actually follow the logic of higher risk return, right? Because for you usually have two kinds of return in your plan. You have the guaranteed portion and non-guaranteed portion, right? So if you are expecting a higher amount, a higher share of the profit for the non-guaranteed portion, and be prepared that the guaranteed portion will not be as good. Because otherwise the insurance company will be losing money. Yeah. To ensure you will get back at least 100% of the premium, we recommend looking at policy that offer 100% capital guarantee. But of course, if you choose 100% capital guarantee, these plans also maybe compared to the plans that are not 100% capital guarantee, they might actually lose on the other factors. Non-guaranteed bonuses. If you have a participating endowment policy, you will be eligible to receive non-guaranteed bonus on top of your guaranteed maturity sum. These bonuses are affected by factors such as performance of investment fund, expense incurred by participating fund, and therefore signals who can pay out for the policy participating in the fund. Right? So, they listed out three factors: performance of investment fund, expense incurred by participating fund. These two are the primary factors. Actually, you can actually sum up that as one factor, because performance of the fund minus of the expense, right, is actually related to your fund performance, and how lean your fund is. Because performance of the investment fund tend to be affected by the overall market condition as well. And the expense of the fund do actually to kind of like matter a lot, because if the fund charges are very high expenses, it's kind of like difficult to give a good return to the investors. Then the next thing on the death or sickness claim payout from the policy participating in that fund. This is actually not a primary factor. So when it comes to the fund performance and the expenses, actually this part is actually determine 90% of the non-guaranteed bonuses. The claim experience of the participating fund do not really actually matter that much. There are two types of bonuses. One is the reversionary bonuses, the other is terminal bonuses. So reversionary bonuses are actually bonuses that are declared regularly to your policy, usually once a year. Usually they are declared once a year, and once they are declared, they will not be taken back. So it is different from, like, say, you invest in your own shares, or you invest in your own stocks. Because we will do our own investment, all the profits are actually floating there in the market, which also known as paper gains. So for this endowment, for once these bonuses are declared, they become part of the guarantee portion of the plan. Then terminal bonuses. Terminal bonuses are added to your policy when the policy matures. So matures, so which means that you reach the end of the policy term. So let's say it's a 10-year endowment plan. At the end of 10 years, you will get a terminal bonuses. Sometimes terminal bonuses is also paid out when there's a claim event for the endowment plan. For example, the insurer of the endowment plan pass away. This is also the time that actually a terminal bonus is actually being paid out. Surrender value. Surrender value is the amount that you will get when you choose to terminate the policy early. So what do we mean by early? At the end of the policy term, your policy mature, that value we call it maturity value. So anytime earlier than that. So let's say it's a 10-year policy. Anytime you decide to surrender it before maturity, is actually you are surrendering early. So you will get a surrender value. So this is your surrender value, projected surrender value will be shown in the product illustration as well. Usually it's not a wise thing to surrender early because surrender early tend to incur losses. So you only want to surrender your endowment policy when you have no other options. So maturity value, we just explained on what maturity value is. It's the amount of money that you will get back when the policy matures. It will consist of two components. One is the guarantee portion. The other is the non-guarantee portion. The non-guarantee portion are actually your reversionary bonuses that you collected over the years, as well as the final terminal bonus. So death benefit, as we said, most of our endowment plans also have a little bit of coverage. So in the event that death happens, usually you will get a death benefit that is higher than the surrender value. So it makes sense if, let's say, the surrender value at the period is $60,000, for example. So maybe the death benefit is $65,000, just for illustration, to give you an idea of how it looks like. Endowment policy are not without risk. Of course, this is actually very clear because not all endowment policy are actually capital guaranteed. So definitely they are not without risk, right? So if you are risk averse, you can always choose an endowment plan that is capital guaranteed. Okay, that's all to sum up on the basic components of an endowment policy. Okay, but it's hard to understand in words. So let me use some drawings. So what is all this? So maybe let me just use a single premium policy, for example. So let's say you invest 100K. Single premium policy are actually policy you do a lump sum investment. You do not have to make regular payment. The reason why I use that as an example is actually it's easier to show. So actually this is the investment value. So assuming if you have a I want to draw a straight line. Okay, it's not very nice. Okay, perspective. Okay, so not drawn to scale. So usually they will have a guaranteed portion. So this is the amount of money you invest in. This is called PP for premium. So this is actually the guarantee cash value. the guaranteed cash value or the guaranteed portion of the plan. As you can see that, let me give you an example. So assuming this is actually this is actually a 20-year plan. So this is time, this is value. So as I can see that if the product design is like this is obviously not a capital guarantee, right? Because the guaranteed cash value, the guaranteed value is 80K constant throughout the years. So when the policy mature, the worst case scenario, you could end up with 80K. 80K. Then we also have the bonuses. We also have the bonuses. So this is the G, guarantee portion. This is the NG, non-guaranteed portion. Non-guaranteed portion. Let me put a bit more. That is easier. So this is the guaranteed portion, where GP is a non-guaranteed portion. This is a non-guaranteed portion. So assuming that if I say the fund is performing well at or the investment return is actually 3%, you see in the product illustration. So actually this 3% refers to the investment return of the company. It's not your personal investment return. So your personal investment return, you have to use a financial calculator to separate calculate it. So this is just a graphical approach to actually show you how it actually means all this guarantee and non-guarantee and what it really means. So let's say for this example, we can see that the guaranteed portion is 80K now, which is constant throughout the 20 years. For the product that's actually has a 20 years time horizon. So when it comes to, let's say, assuming actually when it's 3%, at 3%, this is how much you are. This is actually how much you're going to get when the policy mature. As you can see that this point is actually higher than 100K, 100K by somewhat. But if I say the investment is actually doing better, 4.25 at this point, the value is going to be even much more higher than 100K. So there's no need to give an exact figure. So this is actually for you to understand that actually, of course, this point at 4.25, the total maturity value will be definitely higher than what it is, assuming it's only a 3% investment return for the company. And in the worst case, even if the fund is doing at its worst kind of performance, like the market is crashing, you're still guaranteed at least 80% of the capital. In the worst case, that's 80K. So this is actually a snapshot of how it looks like under different scenario. So worst case, you're going to get 80K if you hold your policy to maturity at the end of the 20 years. And if let's say it's 3%, you're going to get this value, somewhat higher than 100K. If let's say 4.25% investment return, you're going to get an even higher value. But this is only true for maturity. So let's say if you do an early surrender, there's likely to be loss. So actually the surrender value, it will actually looks like this. The surrender value will look like a exponential graph. So this curve is actually surrender value. this current surrender value. This actually means that if you actually do an early surrender, you don't get the full bonus. You don't get a full bonus declared. It's very important. That's why there's actually loss when you actually do an early surrender. You only get the surrender value of the bonuses, so you don't get paid in full. So you only get paid in full when you hold your policy to maturity. So actually, this is the amount of money that you actually lost. So when you look at the what you know what in the product illustration, or in the layman term, as quotation. You get a quotation from you download a quotation from the insurance company or from the insurance website. So actually, you can see that the surrender value is actually a exponential graph. It's actually a exponential graph. Yeah. So if let's say okay, so this is for your understanding of actually what the terms really mean. Okay, if you like my channel, subscribe my channel. If you like my explanation, help me to like my video.